And the U.S. Federal Reserve just made a big move. Interest rates now increasing by 0.75%, and they're expected to keep rising throughout the year. Our Lakita Johnson spoke with a financial advisor who explains what this means for your wallet.
It's the first time the U.S. has seen an increase in interest rates this high in nearly 3 decades. And it's a number of factors that have led us to this costly point.
It seems like most of it is coming from the supply side. When the pandemic hit back in 2020, obviously a lot of businesses were not able to produce as much as they were before.
It's more dollars chasing fewer goods.
Where Americans historically have spent 70 cents of every dollar on services and only 30% on actual physical goods. When COVID came, we swapped. And so suddenly we started buying more stuff.
The war between Ukraine and Russia also disrupted the oil markets. And Summit Asset Management financial advisor and partner Lance Hollingsworth says it's also rumored to have had the same effect on the food. Another issue is China and its zero tolerance COVID policy.
In China, anytime someone gets COVID, they essentially shut down a city.
Which means they also shut down production. While the U.S. Federal Reserve's major hike is meant to stabilize prices, this means it will be even more costly to borrow money for everything from car loans to mortgages, which according to the lending tree has already climbed from 3% in January to 6% now.
They're trying to keep inflation in the 2% range. And so if we go back and look at the last 10 to 12 years of history, they've had a very difficult time getting inflation to 2%. And now suddenly we're running, 8 to 9%.
Hollingsworth says you should also pay down any debt that you have if you're in a position to do so. As far as some of the other impacts inflation will affect, people who have variable interest rate loans. Your credit cards may go up a little bit, but they don't move that much based on the fact that the Federal Reserve based on what they're doing. And if you have an existing mortgage rate, that won't change when it comes to a new mortgage or car loan, you can expect to pay more.